Hello and welcome to the Weekend Investing Daily Bite of 25th of June and a very peculiar day today. Uh, Index, the Nifty was moving up while most of the market was flat or moving down. The story of the day is on sectoral funds. There seems to be remarkably large allocations that are being made to sectoral funds, and this has been reported by the media also today. um, should you be concerned? Should you be going for sectoral funds in such a massive way? This is what we will discuss towards the second half of this daily bite. But first, where the markets are headed. So Nifty has closed at a new all-time high of 23,722. The last two sessions have been phenomenally good for the Nifty. After the gap down yesterday, it moved up strongly throughout the day yesterday, and today a minor gap up, and it just continued to move through. So a lot of index players seem to have been taken by surprise, who were, maybe selling calls here or were looking for a range, but this seems to be a surprise call on them. And today also, like many other sessions in the recent past after the elections, one or two sectors are leading the market, and that is by rotation. So today the turn was for private banking again, and private banks stole the show for most part of the day. Nifty Next 50 was actually, it opened gap up, but closed gap down from yesterday's close. So almost 0.5% loss on Nifty Junior. In terms of mid caps, again, you can see slight gap up, made a small new high and closed down by 0.25%. So no, the downside was not much, but all these stocks did not really participate in in the rally that was seen at the Nifty level. Small caps totally flat, had gone up to a new high, but gave it back all by the close. In terms of the bank Nifty, of course, the bank Nifty, just like Nifty, took support yesterday at this important level and just went through the new high and closing at 52,600. I mean, just see 46,000 on election result day and now 52,000 in a short period of time. Bank Nifty has really caught all the bears unaware, and a lot of private banking stocks are actually the reason for this to happen. FII is totally dull and out. 654 crores of selling by FIIs yesterday. Domestic institutions also selling 820 crores. So there is no institutional support coming in at this stage. Nifty Heatmap, you can see, is kind of divided. It's green on one side and red and gray on the other side. So the left side here is that of HDFC Bank, ICICI Bank, Axis Bank, private banks, and also PSU banks moving up a little bit. Reliance up 0.8%, Infosys and TCS up also marginally, but largely you can see power, autos, FMCG, steel, all down, energy all down versus the two sectors that were running. In the Nifty Next 50 heat map, also primarily red. Some capital goods and manufacturing companies doing well. So Bosch, Motherson's doing well. Zomato has been doing all right. Other than that, LIC has been losing ground. DLF has been losing ground almost on a daily basis. IRFC, PNB, Bajaj Holding, ABB, all down. Indigo down 2%, Dabur down, Adani Power down. So many stocks was just in a corrective mode today. Sectoral trends, nothing much to talk about. Real estate gave up some of the gains of the recent past. Real estate is down minus 1.8% today, down 3% for the week. Still, on a monthly basis, real estate remains the top gainer at plus 9%. And other minor losers were public sector enterprise stocks, metals, commodities, energy stocks. You can see that the main gainer today was only private banking, and on the back of that, Bank Nifty also was riding high. So private banks now have recovered 8% in just 1 month, although the 12-month performance at 17.6 is not looking so bad now. FMCG is one sector that has not picked up yet, 0.3% down today also. And for the year gone by, that is the lowest performer at 9.7. IT stocks doing reasonably all right at 0.8%, along with Nifty at 0.8%. And for the year, IT is now at 24%. In terms of Bank Nifty today, you can see that the weekly Bank Nifty chart has been taking support at this 40 weekly moving average since 2022. And this time also, you can see a very sharp down move on election day has resulted in another swing up on the Bank Nifty. And if we see the private banking index, which had been stuck in this range for the most part of the last 7 months, has broken out 4 or 5 days back and has very strongly moved up. I remember, telling you on this day that this breakout will either go a long way or will just crash down. It seems like we are going up. That seems to be the consensus in the market also. And within the private banking space, if we see, and if we see the last few years, so last 3 years, for instance, you can see the kind of relative outperformance of some banks versus others. So Axis Bank is in the middle at plus 88% last 3 years approximately. ICICI Bank is up 120% in 3 years, whereas HDFC Bank is plus 21% only in 3 years. So this actually brings home the point that look for stocks and momentum within the same space also. Let's say you wanted to stay in private banking space only, then you should be looking for strength in that space and go with that. As and when the strongest leader churns back to being a weakest one, you can always churn your portfolio. So you could have been with HDFC Bank till it was strong, and now that for last 3 4 years it is giving this indication that it does not have the strength to match the other banks, you should have gone with the other banks. But that's how relative performance measuring against each other can be useful for your own portfolio. In terms of stock spotlight today, Amaraja Energy has gone up another 20%. So it's gone from 700 levels in March to 1600 in end of June. A remarkable rally in this. Of course, there is some corporate announcement on this that they've tied up with a Chinese company for lithium ion technology, and that probably can boost it even further. So there are some news that is related to this kind of a price action that is happening. And of course, this also has been stuck in a range for about 8 years. And whenever a very long term range will get broken out, there is a very high probability that a rocket like move will start from there. In terms of gold prices, extremely flat since the last, I would say, 6 weeks, and still waiting for some trigger to happen here, but reasonably stable near 72,000. Dangerous flows in the sectoral funds. That is the topic we want to discuss today. Today, in the Economic Times, this was the lead story, and the numbers are very, very stark. In the last 12 months, I'm quoting from the paper, that sectoral or thematic funds have accumulated 70,000 crores in just last 12 months. And when you compare it with all the others, small cap funds have got only 40,000 crores. Large and mid caps have got only 25,000 crores. ELSS has got only 1,000 crores in last 12 months. Flexi cap is only 20,000 crores. So this particular sectoral thematic fund seems to be, you know, the favorite of the sellers. The who is selling all these funds? It is essentially the mutual fund distributors, the advisors of mutual funds, the bank relationship managers. They are pushing sectoral and thematic funds down the throats of their clients, because in the last 12 months they are able to showcase, see, energy fund has done so much, auto funds have done so much, or some defense fund has done so much, and they are essentially using this last 12-month or 18-month period to focus on the selling part, that this last 18 months is replicatable every 18 months. That does not happen in the market. So this greed of selling whatever sells is the main issue behind it. And I'm not sure, but I think these sectoral and thematic funds also have more incentives from the producers to sell them, and hence these are the ones which are thrust down people's investments, who essentially cannot evaluate for themselves. Sectoral and thematic funds are good only if you are able to time your entry and exits into these funds better. because sectors and themes will keep changing. If you have bought defense today, maybe it won't last after 2 years. Maybe there's so much premium comes in 2 years that the next 10 years get discounted. People who bought into public sector enterprise funds 10 years back probably did not make any money till last year. So there are many themes which may get either overdone or have already crossed. Some green energy themes have already done quite a bit. We don't really know how much more is there to go, at least in the next 2, 3, 4 years. So these funds are, and producers are constantly coming out with new funds. The I don't want to say it, but the whole aim of this industry is to garner funds by hook or by crook. So AUM has to go up because the AUM generates fees. If an average fund generates 1%, if somebody is having 50,000 crores, they generate 500 crores of fees every year. So the business point is, create products, sell products, generate fee. That is the business. But some of these funds are not suitable for a lot of investors. So that is where the role of a good advisor will come in. If you have an advisor who will be able to move you in and out of these sectoral thematic funds, then it is fine. But if you are going to sit on it for 5 years without knowing what is happening in that theme or sector, then I think it is a very, very big risk. I also want to show you some sector rotation data that we have. My team has prepared it with great pains. I will go through this very quickly, and these are the different sectors that we are tracking. And you will see that in each year, different sectors will perform. So, for instance, 2007, private banks, commodities, infra is leading. 2008, all these sectors are down. 2009, auto is leading, IT is leading, commodities is leading. 2010, pretty much flattish, pharma, auto, FMCG. 2011, all down, FMCG up 9%. 2012, private banks and media and real estate now. 2013, IT. 2014, private banks, PSU banks, auto now. 15, everything down, pharma, MNCs. 16, energy and commodities. 17, real estate only. 18, IT and FMCG. 19, real estate. 20, IT and pharma. 21, IT, commodities, real estate. 22, PSU banks. 23, PSEs and real estate and autos also. Okay. And 24 so far, real estate, autos. So what you are seeing across these 17 years of data, every year has different sectors performing, and several sectors don't perform for several years together. Right? You didn't see FMCG really play out big in many consistent years. You didn't see pharma playing out big in many consistent years. So the strategy needs to, make sure that you are in the right sectors. If you get stuck with a sectoral theme and that sector is not performing for years together, then you are stuck. I mean, the seller has got his commission and he's happy, but you are stuck with the thematic scheme. So your either you go into a passive instrument like an index fund where sectors will automatically rotate at least once in 6 months, or you go into active investing where sectoral rotation will be done by the mutual fund manager, or you in some small cases where at least somebody is taking care of if your sector is not performing. If you, for instance, invested in 2008 in 7 in real estate sectoral theme, you would not have had a chance to get out of it for years together, because real estate did not perform anywhere well like that till maybe 12 13, and that also you would have barely recovered your money. So this entire thesis that once a sector has done very well in 1 year and hence you should get people into that is very, very wrong. I think it is a misservice by a lot of sellers. I hope some semblance comes to their mind that business is fine, but there has to be some morality to the business. And main thing is that investors need to be aware, and they need to be cautious of what they are buying, who is selling them what, whether they are fully aware about what they are getting into. That only can really prevent massive losses that happen because of selling at at the wrong time in the market by the sellers. That's all I have for today. Thank you so much. Please write in the comments if you think my thesis on this is right or wrong. Both ways, I'm happy to hear your comments. Do share your thoughts, and see you next time. Bye.